Next up, we are going to talk about something near and dear to my heart, spotting opportunities in market chows. Now, I've seen unfew cycles in my time, unfew. And let me tell you, the best returns aren't made when everyone else is happily investing. They're made when there's blood in the streets, as the old saying goes. This article about Brookfield Asset Management really highlights that philosophy. They've got almost 120 billion ready to deploy uncalled capital, meaning money committed by investors but not yet spent, and they are explicitly looking for distressed assets right now.
Wow, 119 billion. That's a plot of money. So when you say chows, what exactly is happening that's creating feast opportunities? I always thought things just smoothed out eventually.
H-A. Oh, my dear friend, if only it were that simple. Chaos doesn't mean everything is crashing and burning off. Sometimes it feels like that. It means there's a disconnect between price and value. See, markets overreact. Fear and greed are powerful forces. Right now, we've got interest rate uncertainty, geopolitical tensions, all sorts of things making investors nervous. That nervousness leads to sell-off set often. Perfectly good assets get marked down unfairly. Brookfield is saying they want to capitalize on that, scoop up those bargains. It's a classic contrarian strategy. Reminds me of 1973 when oil prices skyrocketed after the PEC embargo. Everyone panicked about energy companies, but if you were smart and had the capital, it was an incredible buying opportunity.
Hmm. So they're looking for things that are good fundamentally, just temporarily undervalued. That makes sense. The article mentioned opportunities. What does that even mean in this context?
Excellent question. Credit opportunities basically means lending money to companies or situations where traditional banks might be hesitant. When markets get choppy, businesses can struggle with funding. Brookfield, through its Oaktree Capital Management arm, which they've been increasing their ownership stake in, by the way, smart move steps in to provide that liquidity. Think of it like being the guy with the umbrella when everyone else is running from the rain. They're earning offness return on those loans and potentially taking an equity stake as well if things get really tough for the borrower. It's not about vulture capitalism. It's about filling a genuine need in the market and getting compensated handsomely for it.
That sounds complicated. They've also raised a significant amount through their real estate fund, almost 16 billion. Is that part of the same strategy? Like buying up properties when prices are lower?
Precisely. Real estate is a big area for Brookfield. What they're seeing, and this is crucial, is that lack of new supply in prime locations. So, demand is still there, even if interest rates have risen. They're looking to acquire properties where the current financing isn't ideal. Maybe there's an adjustable rate mortgage that's becoming too expensive for the owner. Then Brookfield steps in, restructures the debt, and holds on to a quality asset long term. I did something similar myself back in the early 90s with a commercial building in Boston. Everyone was convinced office space would be anti for after a recession. But I saw the underlying location was fantastic. It took some restructuring, but it paid off handsomely.
Well, that's incredible. So, this isn't just about waiting for the market to recover. It's actively fixing things and creating value.
Exactly. It's active management, not passive indexing. They aren't just buying an ETF and hoping for the best. They're rolling up their sleeves, identifying problems, and deploying capital to solve them. And look at this, they also see opportunities in structured investments where companies can't access traditional public markets. That's a sign of real dislocation. That's where you find juicy deals. It's like finding hidden treasure you have to dig for it.
This is all fascinating. They are investing in other asset managers as well, like Angel Oak and Castle Lake. I wasn't expecting that part.
Ah, yes, another shrewd move. Brookfield isn't just about directly owning assets. They are building a network of specialized investment firms. It's like having a team of scouts constantly searching for best opportunities. They increase their ownership in these companies and benefit from the fees generated by their investments as well. It's a clever way to scale up their expertise without taking on all operational risk themselves, and it creates synergistic benefits across the whole organization.
This is giving me a plot to think about. I always assumed investing was just picking stocks, but this seems much more dynamic and requires so much more capital and understanding of complex financial instruments.
You've hit the nail on the head. It's not just picking stocks, although that can be a part of it. This is about understanding macroeconomics, identifying imbalances in the market, and having the resources and, frankly, the courage to act when others are fearful. Oakfield is demonstrating a clear thesis. Market volatility creates opportunities for those who are prepared to exploit them. Now, if you'll excuse me, I think I'm going to review some notes on distressed debt. You never know when the next opportunity will present itself.
HA. Well, that was incredible. It's made me realize how much more there is to learn about investing than I ever imagined. I need a coffee and then to start reading everything I can find on alternative investments.